Becoming a smart investor isn't about chasing get-rich-quick schemes or relying on luck. Whether you're a beginner dipping your toes into the market or a seasoned player refining your approach, smart investing emphasizes long-term growth, risk management, and continuous learning. Below, I'll outline key strategies drawn from expert advice to help you build wealth intelligently. Start by defining what you want to achieve. Are you saving for retirement, a home down payment, or your child's education? Specific measurable goals provide direction and help you choose appropriate investments. For instance, short-term goals might favor low-risk options like bonds, while long-term ones can tolerate more volatility in stocks. Use the SMART framework: specific, measurable, achievable, relevant, and time-bound to make your objectives actionable and trackable. Before investing, ensure you're on solid ground. Pay off high-interest debt, build an emergency fund covering 3 to 6 months of expenses, and secure adequate insurance. This protects your investments from unexpected setbacks and allows you to invest without desperation. Once stable, determine how much you can invest regularly. Consistency beats large, sporadic contributions. Knowledge is your best defense against poor choices. Learn about asset classes, stocks, bonds, real estate, ETFs, market dynamics, and economic indicators. Resources like books, online courses, or financial apps can demystify concepts. Don't rush. Start small and scale as your confidence grows. Spread your investments across different assets to minimize risk. If one sector falters, others may thrive. A balanced mix might include stocks for growth, bonds for stability, and alternatives like commodities. Rebalance periodically to maintain your desired allocation. Time in the market trumps trying to time the market. Historical data shows that patient investors who stay invested through ups and downs often outperform those who jump in and out. Adopt a buy and hold approach, investing consistently via dollar cost averaging, buying fixed amounts at regular intervals to reduce the impact of volatility. Assess your risk tolerance honestly. Aggressive strategies suit the young, while conservatives prefer stability. Minimize fees by choosing low-cost index funds or ETFs, as high expenses can erode returns over time. Stay informed but avoid emotional decisions driven by market hype or fear. Investing isn't set it and forget it, but it takes patience. Monitor your portfolio annually, adjusting for life changes, market shifts, or goal progress. Seek professional advice if needed, but remember, no one cares about your money more than you do. In summary, smart investing combines preparation, patience, and prudence. By following these steps, you'll position yourself for sustainable success rather than fleeting gains. Remember, every investor starts somewhere. Begin today, learn from mistakes, and watch your wealth grow.